The envelope feels lighter than a bank statement. It usually arrives on a Thursday, slipped quietly in between the flyers for grocery store sales and fast food coupons. It does not look dangerous. It bears the logo of a company you probably trust, a company you have paid faithfully for 5, 10, maybe 15 years. Intact. Aviva. TD Insurance. Desjardins. You open it while standing in your hallway, perhaps still wearing your coat, expecting the usual annual annoyance. You expect to see a notification that your premium is going up by $20 a month due to inflation. You are ready to be annoyed. You are not ready to be destroyed. But as your eyes scan the page, the annoyance turns to confusion and then to a cold, sinking dread in the pit of your stomach. The letter does not ask for more money. It does not offer a renewal. And it states, in cold corporate language, that your policy will be terminated effective 12:01 a.m. on the 30th of next month. The reason given is vague. Material change in risk, or perhaps underwriting guidelines have changed, or simply we are no longer writing business in your area. You stare at the paper. You think, this must be a mistake. I have never made a claim. I pay on time. My house is fine. You pick up the phone and call your broker. You expect him to fix it. But his voice is different today. He is not the friendly guy who sold you the policy. He sounds tired. He sounds like he has had this conversation 50 times this week. He tells you that there is nothing he can do. He tells you that he has shopped your file to every major carrier in Canada, and they have all said the same thing. No. Declined. Rejected. You are now in the category of the uninsurable. And while you might think this is just an inconvenience, while you might think you can just go without insurance for a few months until you find a solution, you are wrong. You are catastrophically wrong. Because buried deep in the fine print of your mortgage contract, that 30-page document you signed at the lawyer's office and never read again, is a clause that is about to ruin your life. It is usually standard charge term number 4 or 5. It is the covenant to insure. It states, unequivocally, that the borrower must maintain valid fire and hazard insurance on the property for the full replacement value at all times without interruption. The moment your insurance policy expires at 12:01 a.m., you are in breach of contract. You are in technical default. The bank does not need to wait for you to miss a monthly mortgage payment. They do not need to wait for you to lose your job. The lack of insurance is, in the eyes of the bank, a more serious default than missing a payment. Why? Because a missed payment is a financial loss of a few $1,000s. A house that burns down without insurance is a total loss of the collateral. It is $1 million loss, and the bank will not take that risk for even 1 hour. Welcome back to Canada Property Watch. We have spent the last month documenting the collapse of the Canadian real estate dream. We showed you the bankers fired for fraud. We showed you the audit catching fake income. We showed you the liquidity crisis, wiping out private borrowers. But today, we are going to expose the final silent killer, the one that strikes from the shadows. But the one that affects you even if you have perfect credit and a steady job. We are going to talk about the insurance blacklist and how a decision made by an algorithm in an insurance office is triggering immediate mortgage recalls across the country. To understand the magnitude of this crisis, you have to understand that the insurance industry and the banking industry are two sides of the same coin. They are the twin pillars that hold up the housing market. If one pillar cracks, the roof comes down, and right now, the insurance pillar is crumbling. For decades, insurance in Canada was boring. It was predictable. Companies made money, premiums stayed low, and coverage was easy to get. But in 2025 and 2026, the math broke. The insurance companies are facing a perfect storm of losses. And we are talking about billions of dollars in claims from auto theft rings in Ontario and Quebec. We are talking about catastrophic flooding in British Columbia and Nova Scotia. We are talking about hailstorms in Alberta that stripped the siding off 10,000 homes in 10 minutes. And we are talking about the rising cost of rebuilding, fueled by inflation and labor shortages. The insurance companies are bleeding, and unlike the government, they cannot print money. So they are doing the only thing they can to survive. They are de-risking. That is the corporate buzzword. What it actually means is purging. They are looking at their portfolios and they are cutting loose anyone and anything that looks even slightly risky. They are redrawing the maps. They are changing the rules. And you are the collateral damage. Well, let's talk about the mechanism of the mortgage recall, because this is the part that terrifies financial planners. When your insurance is canceled, the insurer is legally obligated to notify the loss payee. That is your bank. The bank is listed on your policy. When Intact or Aviva presses the cancel button, an electronic notification is sent instantly to the mortgage servicing department of RBC, TD, or Scotiabank. The bank's computer receives the code policy canceled / non-renewal. This triggers an automatic red flag. A letter is generated immediately from the bank to you. It is aggressive. It says, "We have been notified that your insurance has lapsed. You have 10 days to provide proof of new coverage. If you cannot find new coverage in those 10 days, and remember, you have been blacklisted, then the bank activates a protocol called force-placed insurance. This is one of the most predatory and devastating financial products in existence. The bank buys an insurance policy for your home, but they do not shop around for the best rate. They have a deal with a high-risk insurer. They buy a policy that covers only the structure and only up to the amount of the mortgage. It does not cover your furniture. It does not cover your electronics. It does not cover your personal liability if the mailman slips on your ice. And the cost? Force-placed insurance premiums are typically 500 to 1,000% higher than standard insurance. If you were paying $200 a month, the force-placed policy might cost $2,000 a month. The bank does not ask you for this money, and they simply add it to your mortgage balance. Or worse, they add it to your monthly payment immediately. Imagine your budget is already stretched to the breaking point. You are paying $4,000 a month for your mortgage. Suddenly, the bank adds a $2,000 insurance premium. Your payment jumps to $6,000. You cannot pay it. You bounce the payment. Now, you are in default for non-payment and you are a high-risk insurance case. The bank's risk algorithm moves you from watch list to foreclosure. They call the loan. They demand the full balance. They force the sale of the home. And when the home is sold, because it is uninsurable through normal channels, it sells at a massive discount. You lose your equity, you lose your home, all because of a letter from an insurance company. Now, then let's dig into the specific triggers. Why are people getting canceled? It is not just random. There are specific kill switches that are being activated right now. The first and most widespread kill switch is the vacancy clause. This connects directly to the fraud we exposed in the audit. During the boom, thousands of investors bought homes, claimed they were owner-occupied to get a lower mortgage rate and cheaper insurance, but then left them empty or rented them out to high-risk tenants. Insurance companies have woken up. They are now using advanced data analytics to detect occupancy fraud. They have access to utility data in some jurisdictions. They can see if the water usage is zero. They can see if the electricity usage is consistent with an empty house. They can also see the opposite. If the water usage is sky high, indicating an illegal rooming house with 10 students living in the basement. When the insurer suspects you are lying about who lives there, they do not just raise your rate. They void the policy ab initio from the beginning. They accuse you of material misrepresentation. This is the insurance version of a death sentence. When you are canceled for misrepresentation, your name goes into a central database. In Canada, this is often referred to as the HITS database, Habitat Insurance Tracking System. Every insurance company checks HITS before writing a new policy. If they see a cancel for misrepresentation flag next to your name, you are done. No standard carrier will touch you. You are radioactive. You are forced into the residual market or high-risk market where premiums are astronomical and coverage is minimal. And we are seeing investors with portfolios of 5 or 10 homes getting one cancellation, which then triggers a domino effect across their entire portfolio. The other insurers see the flag and cancel the other policies. The investor goes from cash flow positive to bankrupt in 30 days. The second major trigger is the auto theft crisis. This is hitting the suburbs of Toronto, Montreal, and Ottawa with brutal force. You might wonder, what does my car have to do with my house? Everything. Most people bundle their home and auto insurance to get a discount, but auto theft has become a billion-dollar epidemic. Organized crime rings are stealing high-end SUVs, Range Rovers, Lexus, Toyotas, right out of driveways. The insurance companies are hemorrhaging money on these claims. They want to stop insuring these cars in certain postal codes. but provincial regulations make it hard for them to just cancel auto insurance. So, they use the home insurance as the lever. They are de-risking entire neighborhoods. If you live in a postal code with a high rate of car theft and you drive a high-risk vehicle, the insurer might issue a non-renewal for your entire bundle. Or they might impose a condition that is impossible to meet. We are seeing letters going out to homeowners in Brampton saying, "You must install a bollard, a concrete post in your driveway, and a tag tracking system on your vehicles within 14 days. Failure to comply will result in policy cancellation." Homeowners, already drowning in debt, often ignore these letters, or they can't afford the $2,000 to install the security measures. The deadline passes, the policy is cancelled. The bank is notified, the mortgage recall begins. It is a ruthless culling of the herd. The insurers are effectively redlining entire cities, saying, "We cannot do business here anymore." The third trigger is the climate blacklist. This is happening quietly, but it is devastating property values in specific zones. Insurers rely on updated flood maps and climate models. These models have shifted drastically in the last 2 years. A house that was considered low risk for flooding in 2020 might be considered uninsurable for overland water in 2026. If your home is in one of these newly designated zones, your renewal letter might say, "We are removing overland water coverage from your policy." You might think, okay, I'll take the risk, but you can't. The bank requires full replacement cost coverage, which includes protection against all major perils. If you cannot get flood insurance, you are in breach of your mortgage condition. We are hearing horror stories from real estate lawyers about deals collapsing on closing day. Imagine this. You are selling your house. You have a buyer. The buyer has a mortgage commitment. Everything looks good. 2 days before closing, the buyer calls around to get insurance. The insurance agent asks for the age of the roof, the type of plumbing, and the type of wiring. The agent discovers the house has knob and tube wiring or 60 amp service or poly B plumbing. These are common in older homes. In a hot market, insurers would overlook this or give you time to fix it. In this market, they say no. We cannot bind coverage until the wiring is replaced. The buyer panics. To replace the wiring costs $20,000. The buyer doesn't own the house yet, so they can't do the work. The seller refuses to do the work. The insurance company refuses to issue the binder. The bank refuses to fund the mortgage without the insurance binder. The deal dies. The buyer loses their deposit. The seller is left with a stigmatized property that is now known to be uninsurable. The value of that home drops by 30% overnight. It becomes a cash-only deal aimed at predatory flippers. The fourth trigger is hitting the condo market, and this is perhaps the most widespread and underreported issue. It involves strata insurance, or the master policy of the condo building. Just like you have insurance for your unit, the condo corporation has insurance for the building itself, the roof, the elevators, the glass, the pipes. Because of the massive increase in water damage claims from leaking pipes in poorly built glass towers, insurance companies have jacked up the deductibles for condo corporations. A few years ago, a standard deductible for water damage might have been $5,000. Today, it is common to see deductibles of $100,000, $250,000, or even $500,000. This means that if a pipe bursts in your wall and causes $200,000 in damage to the lobby and the unit below, the building's insurance pays nothing, zero. The cost falls on the condo corporation, and the condo corporation passes that cost directly to you, the unit owner where the leak originated. It is called a deductible chargeback. You are suddenly hit with a bill for $200,000. Then you turn to your personal condo unit insurance. But here's the trap. Most personal policies have a cap on loss assessment coverage. They might cover only up to $50,000. So, you have a bill for $200,000 and insurance covers $50,000. You are on the hook for $150,000. Cash. If you cannot pay it, the condo corporation puts a lien on your unit. A condo lien is a super priority lien. It jumps ahead of the mortgage. This terrifies the banks. When a bank sees a condo lien registered on title, they panic. They know their security is at risk. They will often pay the lien themselves to protect their position, and then immediately foreclose on the unit to get their money back. We are seeing condo owners losing their units not because they missed a monthly mortgage payment, but because a toilet supply line burst while they were at work and they couldn't cover the massive insurance deductible gap. This is making entire buildings financial leper colonies. If a building has a history of these claims, insurers might refuse to renew the master policy altogether. When a condo building loses its master insurance, the value of every single unit goes to zero. You cannot get a mortgage on a unit in an uninsured building. You cannot sell it. You are trapped. The fifth trigger connects back to the shadow economy of illegal rentals. Thousands of homeowners are surviving high interest rates by renting out their basements. They put in a second kitchen. They put in a separate entrance. But they never pulled a permit because they didn't want the property tax assessment to go up. And they never told their insurance company because they didn't want to pay the commercial or rental premium. Then, disaster strikes. A tenant leaves a candle burning. A grease fire starts in the illegal kitchen. The fire department comes. They put out the fire, but they also write a report. Fire originated in a legal secondary suite. You call your insurance company to make a claim. The adjuster arrives. He walks downstairs. He sees the stove. He sees the fridge. He checks your policy application is. You check the box that said single family dwelling. He smiles, closes his notebook, and hands you a denial letter. Claim denied due to material misrepresentation. Not only do they not pay for the fire damage, but they also cancel your policy immediately. Now you have a burnt house that is uninhabitable. You have a massive restoration bill, and the bank has been notified that the collateral is damaged and uninsured. They call the loan. You are bankrupt. This is happening every single week in the suburbs of Toronto and Vancouver. It is the dirty little secret of the rental market. The mortgage helper suite is becoming the mortgage killer. There is also a new, terrifying layer to this involving the Canada Revenue Agency. Insurance companies and banks are increasingly sharing data with federal authorities to combat money laundering and tax evasion. If you make a claim for lost rental income on a property, but the CRA sees that you have never declared rental income on your tax return, you are walking into a trap. The insurance claim creates a paper trail of tax evasion. And insurers are legally obligated to report suspicious financial activity. A discrepancy between your insurance status, landlord, and your tax status, principal residence, is a red flag. This can trigger a CRA net worth audit or lifestyle audit. So, by trying to claim insurance money, you might be inviting the taxman to audit your last 7 years of returns. It is a web of surveillance where the bank, the insurer, and the government are all watching the same data points, waiting for you to slip up. So, what happens to the shadow inventory of uninsurable homes? Real estate agents know they exist, but they don't talk about them. These are homes listed on MLS right now. They look normal, but if you look closely, they have been on the market for 90 days, 120 days. Deals keep falling through. Why? And because every time a buyer tries to get insurance, they get rejected. Maybe the house was a former grow-op. Maybe it has a history of sewer backups that makes it uninsurable for water. Maybe it has structural foundation issues. These homes are effectively dead assets. The only people who can buy them are cash buyers, predatory investors who will pay 50 cents on the dollar, do the repairs, and maybe get it insured with a specialty high-risk carrier. For the average family trying to sell their home to move, finding out their home is uninsurable is the end of the line. It wipes out their equity completely. We are also seeing a rise in cancellation for non-payment. This sounds obvious. If you don't pay, you lose coverage. But it is a leading indicator of economic collapse. In the past, insurance was the first thing people paid. And it was safety. Now, with premiums doubling, families are treating insurance as optional. They are gambling. They skip a month to pay for groceries. They skip another month to pay the car loan. The policy lapses. Here is the secret the banks don't want you to know. They are terrified of a mass insurance event. Imagine a wildfire hits a town like Kelowna or Fort McMurray. Imagine that due to the economic crisis, 50% of the homeowners in that town had let their insurance lapse to save money. The fire burns the town down. The homeowners have no coverage. They walk away. They mail the keys to the bank. The bank is left holding the mortgage on a pile of ash. This is a systemic risk. It is a risk that could bankrupt a small bank or a credit union. This is why the big banks are becoming so aggressive with force-placed insurance and mortgage recalls. They are trying to front-run the collapse. They know that the consumer is tapped out. They know that insurance is being dropped, and they are moving to seize the asset before it burns down or floods. What can you do to protect yourself? This is critical. First, pull your insurance policy out of the drawer. Read the exclusions page. Do you have coverage for overland water? Do you have coverage for sewer backup? If you don't, call your broker and ask why. If you can't get it, you need to know that now, not when the basement is full of water. Second, if you have made any changes to your home, a new roof, a finished basement, a rental suite, notify your insurer. Yes, your premium might go up. But paying a higher premium is better than paying for a policy that is void when you need it. Do not lie to the insurance company. The AI is smarter than you. The data sharing is deeper than you think. Third, if you receive a recommendation letter from your insurer asking you to fix the roof, upgrade the electrical panel, or install a backwater valve, do it. Do not ignore it. In this market, a recommendation is a polite threat. The next letter will be a cancellation. Fourth, if you are buying a condo, you must look at the status certificate and specifically the insurance binder for the building. Look at the water damage deductible. If it is $250,000, you need to ask yourself if you can afford that risk. And check your personal policy to see if your loss assessment coverage matches that deductible. And if there is a gap, pay the extra $50 a year to close it. Finally, do not pay your insurance monthly if you can avoid it. Monthly payers are the first to be canceled when a payment bounces or a credit card expires. If you pay annually, you lock in your coverage for a year. It buys you 12 months of safety. It prevents the bank from getting that notification. But for many Canadians, the letter is already in the mail. The decision has already been made. The uninsurable label has been applied. This is the final stage of the deleveraging. First, the economy took your overtime hours. Then the central bank raised your mortgage payment. Then the bank cut your line of credit. And now, the insurance industry is taking away your safety net. When you lose your insurance, you lose your mortgage. When you lose your mortgage, you lose your home. It is a brutal, efficient, automated process. And it is happening right now in a postal code near you. In our next investigative report, we are going to look at the final predator that comes for the distressed homeowner. When the bank has taken what they can and the insurer has denied the claim, there is one entity left that has the power to seize your home without a court order: the government. We are going to expose the skyrocketing property tax liens and how municipalities are quietly auctioning off homes for unpaid taxes, bypassing the banks entirely. This is the tax sale crisis, and it is the final nail in the coffin. But for now, go check your mailbox. Make sure the only thing inside is a flyer for pizza and not a notice from the underwriting department, because in 2026, and a pen stroke from an actuary can do more damage to your life than any interest rate hike ever could. Subscribe to Canada Property Watch. We are reading the fine print that the real estate agents ignore. We are watching the insurers, the banks, and the regulators. The system is tightening, and we are here to help you navigate the squeeze.